Good morning, everyone. Well, first off, I'd like to thank all the people who wrote in yesterday with suggestions for how I might improve my video this year. Your comments were generally helpful, but I must say that giving advice on new lipstick colors really isn't my area of specialty. Nonetheless, I do appreciate your suggestions and look forward to getting some more. Well, the new year began with a reversal of last year's trends. Looking at the G10 currencies, most of the movement was mean reversion. The currencies that gained in December lost, and those that lost, notably the yen, gained. The Australian dollar was the only G10 currency to buck this trend. The mean reversion trend wasn't as uniform among the emerging market currencies, although it did hold in a lot of other markets as gold rallied and stocks generally declined around the world. Now, the beginning of the year is by no means a guaranteed indicator of what's to come. Last year, for example, dollar-yen hit its lows for the year on the 1st of January and its high on 31st December. The S&P 500 hit its 2013 low on the 8th of January and its high on 31 December. Nonetheless, the 1.2% decline in emerging market stocks yesterday bodes ill for emerging market currencies this year, I think, particularly as it occurred despite lower U.S. Treasury yields. It suggests that the Fed's tapering is starting to hit sentiment towards emerging markets, much as it did back in June when they started talking about tapering. So far, the market's expectations of dollar strength this year is indeed playing out. The case looks particularly strong for the dollar to rally against the emerging market currencies as the Fed's tapering draws liquidity away from those countries. Today, the calendar includes several releases from Britain. The nationwide house price index rose 1.4% month-on-month in December, double the expected pace and a sharp acceleration from 0.6% month-on-month in November. The construction for PMI for December is forecast to fall slightly, but mortgage approvals for November are estimated to rise. Such figures, I think, would corroborate the idea that Britain's housing boom continues unabated, and that's likely to support sterling, in my view. Elsewhere, Eurozone's M3 annual growth rate is estimated to have accelerated a bit on a year-on-year basis in November. Nonetheless, the 3-month moving average is forecast to slow further. The main point of interest will be whether bank lending ever starts to turn up. It's been falling on a year-on-year basis since May of 2012, and the pace of decline has been accelerating recently, not decreasing. This must be a big concern for the ECB. Continued deceleration in money growth and contraction in credit should eventually push the ECB to taking further steps to loosen monetary policy. This divergence of policy with the Fed is what I believe will drive Eurodollar lower this year. We have 4 Fed speakers during the day. People will be listening closely for any suggestions on how quickly they expect to proceed with the tapering. For more information, including technical analysis, please read our full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.